Welcome back to the channel. If you've been watching the silver market lately, you've probably noticed something that might feel a little uncomfortable. Silver pulled back. After one of the most extraordinary runs this metal has ever seen, the price dipped. And if you're someone who's been paying attention to silver, maybe even thinking about it as part of your financial picture, that dip probably caught your eye. Maybe it caused a little worry. Or maybe, and this is what we're going to explore today, maybe that dip is actually the most interesting part of this whole story. Because here's the thing, silver didn't just quietly dip. It dipped after hitting a nominal all-time high of around $121 per ounce in January of 2026. Yes, you heard that right. Silver reached $121 an ounce earlier this year, and now it's trading somewhere in the $80 range. So we've already seen a pullback of roughly 34% from that historic peak. And the question that every investor, every saver, every person keeping an eye on their money is asking right now is this. Is this dip a warning sign, or is it a setup for the next move higher? That is exactly what we're going to break down today. We're going to look at why silver surged in the first place, what drove the pullback, what the big banks and serious analysts are actually saying about where silver goes from here, and most importantly, what all of this means in real terms for people like you and me, who are just trying to make smart, informed decisions with our money. So stick around, because this one is worth understanding from start to finish. Let's start with a little context, because without context, numbers are just numbers. Silver had one of the most remarkable performances of any asset class in recent memory. In 2025, it gained roughly 147% over the course of the year. That is an extraordinary move for any commodity. For silver specifically, which spent years being described as the forgotten metal or gold's cheaper cousin, it was genuinely historic. And when silver broke above $94 an ounce in January of 2026 and then kept climbing to that $121 peak, it officially entered price discovery territory, meaning prices it had never visited before in its entire history. Now, when something like that happens, when any asset moves that fast, that far, that quickly, a correction isn't just possible. It's almost mathematically expected. Markets breathe, they expand and contract. Even the strongest, most fundamentally supported rallies in history have had pullbacks along the way. Think about it this way. If you've ever seen a long-distance runner, they don't sprint the entire marathon at full speed. They pace themselves. They might slow down around certain points, catch their breath, and then push forward again. Markets do something similar, even if the reasons are far more complicated. So that $121 high gave way to a correction down into the mid-$70s in the early part of 2026, and prices have since stabilized in the $80 range. That's where things stand as of right now. And before we talk about what comes next, let's talk about what drove the dip specifically, because understanding the why matters just as much as knowing the what. A couple of things happened to put pressure on silver. First, when silver hit those jaw-dropping levels above $100 an ounce, some of the biggest industrial buyers, solar panel manufacturers, electric vehicle companies, actually stepped back from the market temporarily. At $120 silver, the cost of using it in production becomes genuinely significant. These are companies that run on margins, that have budgets, that have to think carefully about input costs. So naturally, some of them paused their buying or reduced orders while the price was at historic highs. That removed a portion of the demand that had been propping silver up, and prices came under pressure. Second, there was significant selling pressure from the investment side. Large institutional funds that had built up big positions in silver, especially leveraged positions, meaning they borrowed money to make bigger bets, got hit hard by that correction and had to sell. When you have a market where lots of people have borrowed money to invest and the price starts to drop, you get forced selling. People aren't choosing to sell, they have to, and that selling accelerates the decline. We saw massive outflows from silver ETFs in the early months of 2026, billions of dollars, leaving in a matter of weeks. That kind of institutional behavior can turn a healthy correction into a steep one very fast. And third, the broader market environment played a role. A stronger U.S. dollar, some uncertainty around Federal Reserve policy, and general risk-off sentiment created headwinds not just for silver, but for metals broadly. These are macro forces, big, economy-wide currents that don't care about silver specifically, but push everything around. Here's what's important though. None of those factors, not the temporary industrial pullback, not the institutional selling, not the macro headwinds, changed the fundamental story of why silver was rising in the first place. And that fundamental story is what this video is really about. Because if the fundamentals are intact, then the dip looks very different than it would otherwise. Let's break down what I mean by the fundamental story of silver. There are really two sides to silver's story, and you have to understand both of them to understand why analysts are still talking about $80, $85, $90 as realistic targets for this year. Silver is simultaneously a monetary metal and an industrial metal. That dual nature is what makes it so unique, and frankly, what makes it so compelling right now. On the monetary side, silver has been used as a store of value for thousands of years. When people are worried about inflation, when they're nervous about the purchasing power of paper money, when the world feels economically uncertain, they often turn to hard assets like gold and silver. That dynamic has been very much alive in recent years. The money printing that happened during the pandemic era, the inflation that followed, the global uncertainty around trade, geopolitics, and currency stability, all of that has kept demand for silver as a financial safe haven elevated. That's not new. That's been part of silver's story for a long time. But the industrial side, that's where the story gets genuinely exciting, and also where it gets genuinely complex. Silver is not just a shiny metal people put in jewelry and coins. It is one of the most electrically conductive materials on the planet. It conducts heat and electricity better than any other metal, and that property makes it essential, not optional, not substitutable in many cases, for a wide and growing range of modern technologies. Think about solar panels. Every single solar panel that gets installed, whether on a rooftop in Arizona, a massive utility-scale farm in Texas, or a renewable energy project overseas, uses silver. The photovoltaic cells that capture sunlight and convert it into electricity are made with silver paste. The energy transition that the world is undertaking, moving away from fossil fuels toward solar and wind power, is creating a structural long-term demand for silver that didn't exist on anything like this scale 20 years ago. Then add electric vehicles. EVs use silver in their electrical systems, battery management systems, and charging infrastructure. As the world builds out EV charging networks and manufacturers ramp up production, that demand keeps growing. Semiconductors use silver. 5G infrastructure uses silver. The expansion of artificial intelligence, the data centers that power it, the servers, the networking equipment, all of that draws on silver. These aren't temporary trends. These are decade-long structural shifts in how the global economy operates, and silver is right in the middle of all of them. Now here's the tension that makes this interesting. The supply side of silver has not kept up with this expanding demand. According to data tracked by market analysts, the silver market has been in a supply deficit, meaning the world is consuming more silver than it produces, for 5 consecutive years from 2021 through 2025. And a 6th consecutive deficit is projected for 2026. Think about what that means. For 5 years running, the world has been drawing down its silver stockpiles to meet demand. Every year there's less and less available in reserve, and yet demand keeps growing. Mines take years to develop. You can't just decide tomorrow to open a new silver mine and have it producing in 6 months. The lead time for mining projects is measured in years, sometimes a decade or more. So even if mining companies wanted to dramatically increase supply right now, they couldn't. That supply constraint, combined with growing industrial demand, is the structural foundation beneath silver's price. This is why serious analysts at major institutions haven't abandoned their bullish outlooks even after the correction. Let's talk about what the actual numbers look like, because I think it's important to ground this conversation in real forecasts from real institutions rather than just general enthusiasm. J.P. Morgan Global Research, one of the largest and most respected financial institutions in the world, projects silver averaging $81 per ounce across 2026, with a potential high of $85 per ounce in the fourth quarter. Commerzbank, the major German bank, forecasts silver reaching $90 per ounce by the end of this year and climbing further to $95 per ounce by end of 2027. Bank of America recently raised their average 2026 silver price forecast to approximately $85.93 per ounce, a 32% increase from their previous estimate, citing supply shortages and long-term industrial demand. Now, if you're watching the price sit at around $80 right now, those numbers don't feel that far away. $90 is not some fantasy price level that requires completely unusual conditions. Based on current analysis, it's within the range of what mainstream institutional forecasters consider plausible within a reasonable time frame. That's not hype, that's just reading what serious financial institutions are actually publishing. At the same time, and I want to be very clear about this, there are legitimate downside risks that we should not sweep under the rug, because responsible thinking about money means considering both sides. UBS, another major bank, has actually downgraded their silver forecast somewhat, calling for a year-end 2026 price around $80, down from an earlier forecast of $85. They're citing weaker investment demand and a smaller-than-expected supply deficit as reasons for a more cautious view. Commerzbank's more bullish case sits at $90, while UBS's more measured case sits at $80. Right now, silver is trading right in the middle of that range. So depending on which way things break, we could be at the bottom of the range or we could be heading toward the top. The risks are real and worth understanding. A stronger US dollar would typically put downward pressure on silver, since silver is priced in dollars globally, and a stronger dollar makes it more expensive for foreign buyers. If the Federal Reserve decided to raise interest rates instead of cutting them, which would make bonds and savings accounts more attractive relative to metals, that could reduce investment demand for silver. A slowdown in China's economy, which is a massive consumer of industrial metals, could reduce demand from one of the most important markets in the world. And if the broader solar industry faces headwinds, perhaps due to policy changes or cost pressures, that could reduce one of the key pillars of silver's demand story. None of these scenarios is the base case right now, but they're possible. And the person who tells you any investment only goes one direction and has no downside risk is someone you should walk away from immediately. Silver has shown in just the last few months that it can move dramatically in both directions. It hit $121, it dropped to the mid-$70s, and now it's back around $80. Volatility is part of the deal here. That's something every person thinking about silver needs to sit with and be honest about. And that actually brings me to something worth pausing on right here in the middle of this video. If you're finding this kind of analysis useful, the kind that tries to give you the full picture without just cheerleading one outcome, please take a second and hit the like button. It genuinely helps this channel reach more people who are trying to make sense of markets without being pushed toward panic or overconfidence. And if you haven't subscribed yet to John Smith 02, now is a good time, because we keep coming back to exactly these kinds of conversations as things develop. All right, let's get back into it. I want to give you a way to think about this situation, a mental framework that I think is actually useful when you're looking at any asset that has had a big run, pulled back, and left you wondering what to do next. Think about the difference between the price and the value of something. The price is what the market is offering right now in this moment. It changes constantly. It reflects every trader's mood, every news headline, every algorithmic trade. The value is the underlying reality, the supply and demand fundamentals, the structural forces, the real-world usage and scarcity. Over short periods, price and value can diverge quite a bit. Over longer periods, they tend to converge. The question a thoughtful investor asks is not just where is the price right now, but does the price make sense given the value I can see in the fundamentals? When silver was at $121, you could make an argument that the price had run ahead of the fundamentals, that excitement and momentum had pushed it higher than the underlying supply-demand picture strictly justified. When silver pulled back to the mid-$70s, the argument flipped, that a price below $80 was arguably undervaluing a metal with 5 years of consecutive supply deficits and growing structural industrial demand. The current price around $80 sits somewhere in the middle, which is probably why you're seeing thoughtful, measured analysts pointing to $80 to $90 as a reasonable range for the rest of the year. Now let's talk about the practical reality of who this matters to, because I think sometimes these market conversations can feel abstract and disconnected from actual life. So let me try to connect some dots. If you're someone who already owns silver, maybe you bought some physical silver coins or bars, maybe you hold a silver ETF, you've been on quite a ride. If you bought anywhere close to those January highs, you've seen your position pull back significantly, and that doesn't feel great. But the question to ask yourself is whether your reasons for buying silver in the first place have changed. If you believed in the supply deficit story, in the industrial demand story, in silver's role as a monetary hedge, have those things changed? If the fundamentals you invested based on are still intact, a price correction is uncomfortable, but it doesn't necessarily mean the original thesis was wrong. It just means the market took a longer, bumpier path than you expected. If you're someone who's been watching silver from the sidelines, curious about it but not yet involved, the current situation is one that thoughtful analysts say is worth paying close attention to. The metal has pulled back more than 30% from its highs. The structural story, supply deficits, industrial demand, monetary hedge appeal, is still very much in place. Whether this represents a genuine opportunity or whether it needs more time to play out is something only you can decide based on your own financial situation, your time horizon, and your appetite for volatility. And if you're someone who has zero interest in owning silver directly but wants to understand what's happening in the broader economy, the silver story actually tells you a lot. The fact that silver surged as dramatically as it did tells you something about the anxiety in the global economy around currency values and the buying power of paper money. The fact that industrial demand is growing so rapidly tells you something about how fast the energy transition and the technology revolution are actually moving in the real world. These aren't abstract forces. They're reshaping supply chains, investment decisions, and economic policies around the globe. Let me also touch on something that I think often gets overlooked in these conversations, the gold-to-silver ratio. This is a comparison that has been used by metals analysts for generations. It simply measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, that ratio has averaged somewhere around 50 to 60, meaning it took about 50 to 60 ounces of silver to equal the value of 1 ounce of gold. In recent times, that ratio has been running above 90, meaning silver has been historically undervalued relative to gold, even after its big run. If silver were to return toward historical norms of that ratio, it would imply significantly higher silver prices relative to where we are today. Now, the gold-to-silver ratio is not a perfect predictor of anything. Markets don't simply revert to historical averages on a schedule. But it is one of the data points that serious analysts use when thinking about the relative value of silver versus gold. And the fact that this ratio remains elevated, even after silver's extraordinary 2025 performance, is one of the reasons why many analysts remain constructive on silver's longer-term outlook. Here's another angle worth considering. Solar panel demand for silver specifically is a story that's still very much developing. In 2025 and into 2026, there were some reports of weaker-than-expected demand from the photovoltaic sector as prices climbed. Some manufacturers reportedly began researching ways to reduce silver content in their panels to manage costs. This is a genuine risk factor for silver's industrial demand story. If the solar industry finds ways to use less silver per panel, that reduces the structural demand argument somewhat. Technology does what technology does. It finds efficiencies. However, the counter to that argument is scale. Even if each individual panel uses a bit less silver than before, if the total number of panels being installed is growing at the rate that energy transition projections suggest, the total demand for silver from solar could still remain very large. The net effect of thrifting versus volume growth is something analysts are actively debating, and it's a genuinely important variable to watch. The electric vehicle story is a bit more straightforward. EVs use silver in ways that are fairly consistent across manufacturers, in charging contacts, in circuit boards, in battery management systems. As EV adoption grows globally, this source of demand should grow with it. And AI infrastructure, the data centers, the cooling systems, the networking, continues to expand rapidly, creating yet another source of structural demand that wasn't part of the silver equation in any significant way just a decade ago. So when you step back and look at the full picture, what you see is this. Silver had a historic run. It corrected sharply from an all-time high. The correction was driven by a combination of temporary industrial buyer hesitation, forced institutional selling, and macro headwinds. But the structural fundamentals, 5+ years of supply deficits, growing demand from solar, EVs, semiconductors, and AI, silver's dual role as both an industrial metal and a monetary asset, and its continued historical undervaluation relative to gold, those things have not fundamentally changed. Serious institutional forecasters at J.P. Morgan, Commerce Bank, and Bank of America are projecting silver in the $80 to $90 range by year-end 2026. More cautious voices like UBS see it trading broadly sideways around $80. The most bullish scenarios from analysts like Larry Lepard and others suggest $90 to $100 or beyond is possible if the structural deficit widens and investor interest returns strongly. The bearish risk scenarios involve a strong dollar, Fed rate hikes, Chinese economic slowdown, or solar demand surprises to the downside. What does this mean practically? It means silver is in a genuinely interesting place right now. Not a simple place, not a sure-thing place, but an interesting one. The dip from $121 to $80 has reset expectations and valuations in a way that creates a more balanced risk-reward picture than existed at the peak. Whether $90 is the next meaningful target, as some analysts suggest, or whether silver consolidates for a while longer before its next meaningful move, nobody can say with certainty. Anyone who tells you they know exactly what silver will do next is not being honest with you. What we can say is that the structural case for silver over the medium to long term remains among the more compelling stories in the commodity space right now. The energy transition is real, the technology revolution is real, the supply deficit is real, the monetary uncertainty driving safe haven demand is real. These forces don't turn on and off like a light switch, they build over time. As we wrap this up, I want to leave you with a few things to think about, rather than specific instructions, because this channel is not in the business of telling you what to do with your money. That's not my role, and frankly, anyone watching a YouTube video should not be making major financial decisions based solely on that video. Talk to a financial professional, do your own research, think carefully about your own situation. But I do want to give you a framework for thinking clearly. When you see a dip in an asset that has a strong underlying story, the first question to ask is whether the story changed or whether the price changed. In silver's case right now, the price changed dramatically. The story, the supply deficit, the growing industrial demand, the monetary hedge appeal, that story has not changed in any fundamental way. Second, always consider both sides. We covered the bullish case and the bearish risks today because both deserve your attention. Third, think about time horizon. Silver has shown it can be extremely volatile in the short run. If your horizon is tomorrow or next week, silver's volatility could be very uncomfortable. If your horizon is measured in years, the fundamentals have a chance to matter more than the day-to-day noise. And finally, stay curious. The silver market, the energy transition, the technology revolution, the global currency picture. These are all massive interconnected stories that are still playing out. Staying informed about them, understanding how they connect to your financial life, is genuinely valuable regardless of what specific decisions you end up making. That's going to do it for today's video. If you made it to the end, I genuinely appreciate it. This was a lot of ground to cover, and the fact that you stayed with it tells me you're the kind of person who takes this stuff seriously. Hit the like button if you found it valuable. Leave a comment below. I'd love to know what you think about silver's current situation, whether you're bullish, cautious, or somewhere in between. Subscribe to John Smith 02 if you haven't already, because we're going to keep tracking this story as it develops throughout the year. Take care of yourselves, stay curious, and I'll see you in the next one.